Hey, Dan Passarelli here. Well, today the market was up 1.3% by the end of the day, the market being the S&P 500 as measured by the SPY. That is ahead of a really big day. We had the FOMC meeting start today, and tomorrow is when they will announce what happens with interest rates. That's a big deal. There are basically two competing forces. They're sort of opposite forces. One force needs rates to go higher, and one force needs rates to not go higher or maybe even go lower. So there's this sort of headbutting of economic necessities going on here. And, with that in mind, will market volatility increase? And my answer is yes. And I'm going to talk about why volatility is about to increase. As you've been following our videos, inflation has reared its ugly head and it's still high, right? It's still higher than expectations and it's still a problem. And the only way to get that down is to cool the economy. Less jobs, less economic activity, right? And so in order to do that, the Fed needs to raise interest rates. Inflation is bad for everyone. I mean, you can argue, hey, if I owe a lot of money and own a lot of assets, maybe inflation's good for me, but what it will do to everybody else and what it'll do to the economy, and if it gets really rampant and we see hyperinflation, it's a bad thing. So inflation's not really good for anybody, right? So the Fed, in that regard, kind of has to raise rates. Now, on the other side of that, we have the banks, and because interest rates rose so fast, so much, that's one of the things that's really killing a lot of these banks. I mean, there's a lot of issues. Some of it is bad oversight, some of it's bad management, some of it is crypto, but some of it is the fact that banks loaned out money at low interest rates, and now they have to pay high interest rates, and maybe didn't do a good job foreseeing that, the management of some of these banks. The only way to solve that problem is to lower interest rates, right? Or at least to stop raising them. So we've got these two big competing forces, but here's the thing. One's a long-term problem, one's a short-term problem. The inflation rate is a long-term problem, needs to be solved. The banking thing, the strong are going to survive. The ones that didn't get their hands in crypto are going to survive. The ones that have smart managers and sold off some of those loans, hedged interest rates, et cetera, did a good job running the banks are going to survive. It's just the short-term crunch, making sure that some of these medium-sized banks don't continue going under and that sort of thing. And so whatever the Fed does tomorrow, and by the way, at this point, there's an 86.4% chance that the Fed raises interest rates by 25 basis points. That is according to the Fed funds rate at CME Group. Whatever the Fed does tomorrow, it's going to have its typical Fed volatility. We're going to have a volatile afternoon. And then we're probably going to have a little bit of follow through tomorrow, maybe Friday. But things are going to come to a head. The market's going to realize that this inflation thing's not over. The market's going to realize that there's still a battle being fought ahead of us. And Powell and his cronies are going to, be giving speeches, and they're going to be talking about it, and it's going to continue moving the market. And some of the people who are looking for no interest rate rise or interest rate cuts, I think may be unpleasantly surprised. And I think we're entering a period of additional, higher volatility. In fact, if we go to a chart of the VIX here, VIX, pull this up over a year, I mean, for a long time, 20 was basically the floor, right? We would get down to it, kiss it, get a little bit below it. I guess really, to be fair, maybe 19 was the floor. And it wasn't really until January of this year that the floor dipped down to 18, that's going to stay a floor. In fact, I think that the floor might rise back up to 19. And I think that we're going to see some more of these spikes. I think that what looks to be maybe a temporary spike here is probably just the start of a new, at least short-term regime for a couple of weeks. So what does that mean to you? Well, as a long-term investor, hey, if you're looking 5, 10 years from now, you're not looking at retirement anytime soon, it doesn't really matter. You hold on to your stocks and they'll be fine. If you're a little more clever, you can hedge in the short term. But if you're a trader, it means a world of opportunity, especially when it comes to straddles. Now, you've heard me talk about straddles in the past, and straddles are really tricky to trade if you don't have a solid methodology. Well, guess what? Market Taker does have a solid methodology, and it's not really that hard, and I'm going to be sharing it all in an upcoming online training like we have. I think it's really important to register for this upcoming online training. And so right after this, the place to register is going to pop up. And I hope that helps. And I know this online training is going to help. So register for it. This is Dan Passarelli, Trade Smart. See you on the online training.